Okay, let's discuss now how electricity is traded. Electricity is traded through bilateral contracts between producers and consumers and in organized markets called power exchanges, such as EPEX and North Pool. These power exchanges facilitate day ahead trading and sometimes also intraday trading. This means buying and selling electricity now for use tomorrow. The day ahead markets are a key trading platform in Europe because they make it easy for buyers and sellers to adjust the amount of electricity they've contracted on short notice. They're not only convenient for traders, they also provide a public reference price. Typically, when we talk about the electricity price, we mean the day ahead power exchange price. So, first, let's look at how electricity is traded in day ahead markets. Here you see the results of the EPEX market. This is a zoomed in portion of a much larger curve. The gray line represents the supply bids, which are arranged from low prices to high prices. The orange line represents the demand bids, which are inversely arranged from high to low. The point where the demand and supply intersect is the market price. This market price applies to everyone. All supply bids lower than the market price are accepted and receive the market price. Likewise, all demand bids higher than the market price are accepted and they pay that same market price. The other bids are not accepted. Why not? Because if one additional unit of power were to be produced, the cost, as shown by the gray line, would be higher than what the consumers are willing to pay. So it's not possible to meet any more demand because production would cost more than it would be worth to the consumers. In other words, the value is too low compared to the cost. This is the market outcome, and if everyone bids optimally, it's also a socially optimal outcome. So, how do parties bid? Let's start with a fossil plant. It has two types of cost. Fixed costs, or capital costs, consist mostly of the payments made to the financiers of the plant. This includes the fixed operating and maintenance costs. Then there are variable costs, such as fuel costs, CO2 costs, and perhaps also some operational wear and tear. So, when you bid a plant into the day ahead market for tomorrow, at what value should you bid? You bid at the variable costs, as they are the costs that you need to recover at the very least. For example, imagine your variable costs are 20 euros per megawatt hour. And let's say the market price is 15 euros per megawatt hour. That means that for every megawatt hour that you produce, you spend 5 euros more than you receive. So the more you produce, the more money you lose. That's not a good idea. So in this case, it's better to stop the electricity production of this plant. Now, if the price is higher, let's say 25 euros per megawatt hour, then you earn 5 euros per megawatt hour for every megawatt hour that you produce. Now you're making money. The more you produce, the higher your net revenue. Whether or not this is enough to pay off your fixed costs doesn't matter. Earning a positive cash flow is always better than not having this positive cash flow. So, for a renewable plant with zero marginal costs, you always want to operate it as long as the market price is positive. Now, let's look at what happens if you try to bid higher than your variable cost. Maybe you think you can make more profit by bidding higher. For a demand of 1200 megawatt in this case, the market price is 20 euros. Your operating profit is 5 euros now. But let's say that your average fixed cost is 7 euros, and you would like to try to recover that in this hour. So you set your bid price at 22 euros. Now, the other bid, the price setting bid, becomes cheaper than yours. So your plant moves to the right in the merit order. By bidding higher, you've priced yourself out of the market. You're not longer selected to sell electricity. Earlier, you had a positive cash flow of 5 euros per megawatt hour. Now you earn nothing, losing an opportunity to earn €5 per megawatt hour. So it would have been better to keep your lower bid of €15. Now, if everyone thinks this way, the gray supply curve ends up reflecting the true variable costs of generating power. And the way to minimize the societal cost of power generation is to minimize operating costs. And that is what this market does. So as you see, a power exchange closely mimics economic theory. If the exchange works perfectly, it leads to the ideal economic outcome. This example may cause you to ask how the fixed costs of the plant are received. Because the power price changes all the time, some plants run some of the time and other hours they don't. They run when the price is above their variable costs and they stop when it's below. So how do they recover their investments? Well, their investments are recovered through the sum of all their operational profits throughout the year, so the sum of all the blue areas. Here we see an example of the distribution of electricity prices in a country. These are all the day-ahead prices of the whole year sorted from high to low. You see that for a couple of hours per year, prices go quite high, into the hundreds of euros per megawatt hour. On the right-hand side, you see that sometimes prices are negative. That's when there's oversupply. Now, let's say that your operating costs are as indicated by the dashed line. Then you would operate 80% of the time. The remaining 20% of the time, the market price is lower than your operating costs, and then it's not profitable to operate. The difference between the market price and your operating price is your operating profit. This is indicated by the orange area in the graph. You see that in some hours you make more profit than in other hours, but the point is that the integral of the difference between the price and the variable costs, which is indicated by the orange area, that total area should be enough to recover your fixed costs. If not, then you make a loss. So this is also the challenge for investors. They need to estimate the future prices and costs to determine their expected profitability. Especially the prices are difficult to estimate. Therefore, producers of electricity like to sell long-term contracts. In this case, the generator sells its output to one or more consumers at an agreed price. For instance, a fixed price or a price that is indexed to the fuel and the CO2 costs. In principle, both sides know what they will pay or receive. Then, total revenue is the price multiplied by the volume of the contract. Now, how do they set a price like that? As a generator, at least you want to recover your total costs. So, the lowest price per megawatt hour that you want to receive is your total cost, average plus fixed cost, variable plus fixed cost, divided by the number of megawatt hours that you sell. In other words, your average costs have to be reflected by the price of the contract. When do consumers engage in contracts like that? When they prefer the certainty of a stable price and when the price of the contract is not too much higher than the expected average market price. Thank you for your attention.